What if I told you there's a way to invest that's simpler, cheaper, and more effective than what most professional money managers do? Sounds too good to be true, right? Well, it's not. It's called index fund investing, and today I'm going to show you exactly how it can be your secret weapon for building long-term wealth, even if you're a complete beginner. So let's start with the basics. What exactly is an index? Think of it like a shopping list for the stock market. An index tracks the performance of a specific group of stocks. The most famous one is the S&P 500. This index is a list of the 500 largest publicly traded companies in the United States. You've heard the names: Apple, Microsoft, Amazon, Google. When you hear on the news that the market is up, they're usually talking about an index like the S&P 500. There are thousands of different indexes out there, tracking everything from small companies to international stocks, to specific sectors like technology or healthcare. Now, an index fund is a type of investment that simply buys all the stocks on one of these lists. So, an S&P 500 index fund will own a tiny piece of all 500 of those major U.S. companies. It doesn't try to be clever. It doesn't try to pick winners and losers. Its only job is to mirror the performance of the index it's tracking. If the S&P 500 goes up by 10% in a year, your S&P 500 index fund will also go up by about 10%. It's a beautifully simple, hands-off approach. You're not betting on a single company, you're betting on the overall growth of the entire market. This brings us to a shocking fact. Index funds consistently beat most professional investors. That's right. The highly paid experts on Wall Street, with their fancy degrees and complex algorithms, usually fail to outperform a simple, boring index fund over the long term. Why is this? There are two main reasons. First, picking individual stocks is incredibly difficult. It's nearly impossible to consistently know which companies will soar and which will stumble. Even the pros get it wrong all the time. By buying an index fund, you don't have to guess. You own the winners, but you also own the stocks that don't do as well, and over time, the winners tend to pull the whole average up. You're guaranteed to capture the market's average return. Second, and this is a huge one, is fees. Actively managed funds, where a manager is trying to beat the market, charge very high fees to pay for their research, salaries, and trading costs. These fees eat away at your returns year after year, creating a massive drag on your portfolio's growth. Index funds, on the other hand, are run by computers and have incredibly low fees. This cost advantage is a powerful force that compounds over time. Think about it like this. Imagine two runners in a race. One is a professional athlete, but they have to run with a heavy backpack full of rocks. The other is just an average runner, but they have no backpack. Who do you think will win a marathon? The average runner, of course. The backpack of high fees is what holds back most active investors. By choosing a low-cost index fund, you're ditching the backpack and giving yourself a massive head start. Legendary investor Warren Buffett has repeatedly said that for most people, a low-cost S&P 500 index fund is the best investment they can make. When one of the greatest investors of all time gives you that advice, it's probably wise to listen. So, you're convinced. How do you actually buy one? It's much easier than you think. You don't need to call a stockbroker in a suit. You can do it all from your computer or phone in just a few minutes. The first step is to open a brokerage account. Think of a brokerage as a store where you can buy and sell investments. There are many great low-cost options available today like Vanguard, Fidelity, or Charles Schwab. Opening an account is usually a simple online process, similar to opening a bank account. You'll need to provide some personal information and link a bank account to transfer money. Once your brokerage account is open and funded, it's time to choose your index fund. You'll see them listed with a ticker symbol, which is a short code of a few letters. For example, some popular S&P 500 index funds are VOO, IVV, or FXAIX. Don't get overwhelmed by the options. For a beginner, a broad market index fund is a fantastic starting point. This could be one that tracks the S&P 500 or even a total stock market index fund, which holds thousands of U.S. stocks, both large and small. Once you've chosen your fund, you simply enter its ticker symbol, decide how much money you want to invest, and click Buy. That's it. You are now an owner of a diversified portfolio of hundreds or even thousands of companies. You're an investor. Now let's talk a bit more about those fees, because this is where the devil is in the details. The fee for an index fund is called the expense ratio. This is an annual percentage of your investment that the fund company charges to cover its operating costs. For index funds, you want this number to be as low as humanly possible. We're talking about numbers like 0.03% or 0.004%. That means for every $10,000 you have invested, you're only paying $3 or $4 a year in fees. It's practically free. Compare that to some actively managed funds that might charge 1% or even more. That might not sound like a big difference, but over 30 or 40 years of investing, that 1% difference can cost you hundreds of thousands of dollars in lost growth due to the power of compounding. So when you're comparing index funds, always look at the expense ratio. Lower is better. Your future self will thank you. Okay, let's put this all together with a simple beginner portfolio example. This is often called a lazy portfolio because it's so easy to set up and manage. A great starting point for many people is a 2-fund or 3-fund portfolio. For a very simple approach, you could put 100% of your investment into a single target date fund. These funds automatically adjust your investments over time, becoming more conservative as you get closer to your planned retirement year. You just pick the fund with the year closest to when you think you'll retire, like a Target Date 2060 fund, and the fund does all the work for you. It's the ultimate set-it-and-forget-it option. If you want a little more control, a classic 3-fund portfolio is fantastic. It consists of 3 basic ingredients. First, a U.S. total stock market index fund. This gives you exposure to the entire U.S. economy. Second, an international total stock market index fund. This diversifies your holdings across the globe, so you're not just betting on one country. And third, a total bond market index fund. Bonds are generally safer than stocks and help to smooth out the ride when the stock market gets bumpy. The percentage you allocate to each fund depends on your age and risk tolerance. A younger investor might put 60% in U.S. stocks, 30% in international stocks, and 10% in bonds. An older investor nearing retirement might want more in bonds, maybe 40% or 50%, to reduce risk. The beauty of this approach is its simplicity and diversification. With just 3 funds, you own a piece of tens of thousands of companies and bonds from all over the world. The most important part of this strategy isn't picking the perfect funds or the perfect allocation. It's consistency. The real magic happens when you set up automatic investments. Decide on an amount you can afford to invest every week or every month, whether it's $50 or $500, and have it automatically transferred from your bank account into your index funds. This is called dollar cost averaging. When the market is down, your fixed amount buys more shares. When the market is up, it buys fewer. This removes emotion from the equation and forces you to buy low, which is exactly what you want to do. You just keep investing consistently, month after month, year after year, through market ups and downs. Don't panic and sell when the market drops. In fact, those are the best times to be buying. Investing in index funds isn't a get-rich-quick scheme. It's a get-rich-slowly, but surely plan. It's about harnessing the power of the global economy, keeping your costs incredibly low, and letting the miracle of compound growth do its work over decades. It's boring, and that's what makes it so brilliant. You don't need to be an expert. You don't need to watch the market every day. You just need a simple plan and the discipline to stick with it. Thanks so much for watching. I hope this cleared up the world of index funds for you. If you found this helpful, please hit that like button and consider subscribing for more simple guides to building wealth. Let me know in the comments if you have any questions or what topics you'd like to see next. See you in the next video.